Okay. Welcome, everybody. Welcome to Transform with Greg Carson. I'm here with the Transform podcast, where we talk about the transformation of market ecosystems and pretty much everything else from ecosystems to health to spirituality to everything that we might want to know. This week, we have an amazing guest. We have Taran Sabharval, who's the founder of Stix. It's an OTC platform for secondary markets transactions in digital assets. Basically, he comes from physics at Cambridge University and is the president of the Cambridge Blockchain Association. We're very lucky to have him. It's on our 3-part series on secondaries. The last series we did with Justin Vernon from Industry Ventures. This one we're doing with Taran, and the idea is to go through each of the different secondaries types investments people can make and learn as much as we can about it. So very happy to have you here. I'm going to hand it over to you, and welcome, Taran.
Thank you. Thanks for having me, Greg. It's my honor.
Great. So we're going to start this off with basically a little bit of just maybe you want to tell us a little bit about yourself and about Stix to start with, and then I'm going to go into some questions. And the idea here is just to have an open discussion around secondaries, your background, your vision, where markets might go. We'll kind of leave it open, but give us a little introduction, Taran.
Will do. Yeah. Hello, everyone. I'm from India. I moved to the UK when I was a kid. I grew up in the UK, and I started a company called Stix early this year. We're a team of about 9 people now, focusing on building the most trusted OTC platform for secondary market transactions. Where we differ from other secondary platforms is that we focus mainly on digital asset transactions, and these transactions that we focus on, most of the times we're the only liquidity avenue, and we've been doing this for the last 2 years or so. We've been trading secondaries for the last 2 years. The team overall has over 25 years of experience in private equity, investment banking, and secondaries. My background, obviously, as Greg mentioned, I studied physics at Cambridge, and this is my startup outside of university. I'm a recent graduate, and yeah, I started the company officially in April. Very, very lucky to have had a seed round in June, which Humla was part of.
Great. Yes. I'm very excited about Taran and his company. Why don't we start with a little bit of a little question, Taran? Just explain what a secondary is from your standpoint, and then also how that translates to a secondary transaction for like a digital asset or a crypto asset, or let's just start with what is a secondary?
Let's actually start with what a primary is. A primary is when there's a first issuance of an asset. When companies usually want to either allocate shares to their team members or raise money through a sale of shares, they raise round in a primary investment round. And a secondary round is actually quite simple. A secondary transaction is when a holder of an issued asset wants to sell to another buyer, and that transaction happens in the secondary market. And lots of these transactions, these transactions could take on many forms. It could be direct equity sales, it could be secondary market loans, and so on. And generally, the sellers are either team members or investors in the company who want liquidity on their positions, and buyers buy either their positions entirely or partially. And that
right.
is a secondary transaction.
So you're saying a primary is an investment where the money goes into the company and provides capital for operations, and a secondary, as you say, is basically one investor buying the stake of another investor, whether it be in any asset. And I guess you can buy secondaries in stocks or companies or real estate or anything. And in your case, your first product at Stix is digital assets. So why don't you just 2 seconds of what a digital asset is in our standpoint, or a crypto asset, and how that actually manifests itself as a secondary in your world.
Yeah, so the entire industry is actually built around this idea of a blockchain. And whenever anyone refers to a digital asset, they're actually referring to a new asset class that this industry has created called tokens. Simply put, we are trading tokens in a secondary market, and the transactions are usually for locked positions which couldn't otherwise be traded on, for example, exchanges. And what was the second part to your question, Greg?
Oh, say that again.
What was the second part to your question?
Oh, the second was okay. So, how does a digital asset token get traded? I mean, as a secondary, because we know that a token is traded. We know that a token is traded on like a central exchange, like a BitMEX or a Binance or a Kraken or a Deribit, and we know how it's traded on a decentralized exchange like SushiSwap or something like that. But what is an actual secondary transaction, and how does that actually work?
Yeah, sure. I think what's good to understand is the way projects actually raise money for building their products, and they do this by issuing token sales in private rounds. And they do these historically. They've done these through instruments called SAFTs, right? A SAFT is simply put a simple asset for future tokens, which is its counterpart in the real world, in the tech world, is a safe, a simple asset for future equity, which is a very well-known investment instrument that is used in the tech industry. So whenever investors are issued these instruments, it could either be a SAFT or a token warrant or any of the dozen other structures that we've seen over the last year. They actually get a piece of paper which basically gives them an obligation or a right to receive tokens in the future if the company does do a primary issuance of tokens. And historically, companies have gone through many different hoops and hurdles to issue these assets. In some cases, they've done it onshore, for example, in the US, Singapore, in Europe, or in most cases, they actually just go offshore. The most popular jurisdictions are obviously, the Virgin Islands, Cayman Islands, and others include like Seychelles, Panama, and so on.
So does your platform deal with any jurisdiction? Does it have a jurisdictional element to it, or does it help people manage or understand the jurisdictions?
Yeah, so part of our whole offering is to provide the compliant rails wherever we can and do it in a compliant fashion. We can serve global clients regardless of their jurisdiction. We're regulated. We're regulated as a company. We want to be positioned in the Middle East going forward. So we can we can actually trade assets in all jurisdictions and to all clients, obviously, except for sanctioned jurisdictions.
Okay, so you're saying that you can actually do OTC trades for people looking to either sell a secondary stake in their company or in a company they've invested in, and you can facilitate buying them in any jurisdiction. Is that correct?
That's right. I mean, there are hurdles in some jurisdictions. So for example, in the US, you have to be an accredited investor. For some specific assets that, they have their own requirements. For example, the buyer actually needs to be a qualified investor, which has its own definition under FINRA and SEC laws, which in most cases is either $5 or $10 million assets under management. So there are some requirements when it comes to especially US based clients, but mostly in most other jurisdictions, we're able to serve clients of most types.
Okay, and so I heard you talk about SAFT. I heard you talk about token warrants. I think you also mentioned a locked torrent or a locked token or a vesting token, and then there's also like private tokens. Can you explain or just give us little definitions of these things and how they fit together?
Yeah, sure. The industry actually used SAFTs for, all the way from like 2014, 2015, all the way up until 2021, right?
Mm-hmm.
And more recently, the industry shifted to a structure using token warrants. And the current go-to investment structure for all crypto companies, for example, is issuing a safe, just a simple safe note, which gives the investor, rights to, own shares in the future if there's an equity financing round. And then on top of that, they also get a right to purchase tokens in the future, which is a token warrant.
Okay.
And this token warrant is also issued alongside the safe. And this structure was actually come up with mainly due to unclear securities laws in the US, because crypto is still very heavily US dominated.
Mm-hmm, mm-hmm.
And then secondly, it's also a very neat structure so that investors are also aligned with long-term vision of the company in case the actual legal entity has any value in the future as well. So the safe note will give them right to shares in the future, bars and conditions. So the industry shifted to this so that the investors can get a piece of the pie, whether it's equity or
Mm-hmm.
tokens or both.
Mm-hmm.
In most cases, it's both.
So a token warrant acts like a normal warrant. It has like a strike price, it has a term, and it has and do they have to buy it up front? Is that correct? Or
Yes,
expand on that if you can.
they actually buy the token. They buy the token warrant up front, and then they
Mm-hmm.
pay upon exercising the warrant. Upon exercising this warrant, they have to provide usually the company with a wallet address to receive the token in
Mm-hmm.
the future. And
Right.
as you know, we go through thousands of these documents on a monthly basis, actually, and these documents also have particular terms around vesting period of these
Mm-hmm.
tokens in the future. Say, for example, obviously, if a company is going to sell tokens to investors, the investors should be long-term aligned, and they're usually locked up for multiple years. And this lockup is usually also mentioned in the token warrant.
I suppose it actually would be easier to buy someone's token warrant because it's just an address where the token will be placed, right? So if you have a token warrant with a firm, they're supposed to put 1 million tokens into wallet XYZ123. The transaction may or may not be regulated, but it's very easy just to buy that economic interest without as much hurdles as you might have to get onto a jurisdictional cap table.
It actually is a bit more nuanced than that. It actually completely depends on whether or not the token warrant has been exercised. Pre-exercise, usually there's no wallet address for the tokens to be received. So the reason why companies do that is to defer wallet addresses to the future. Say, for example, there's a team building a brand new layer 1 protocol, right? So, of course, the tokens are not going to be ERC20. It's going to be a token on the native network for that blockchain.
Yep.
And so you need infrastructure to actually set up these wallets. And this takes a while to develop. For example, I think a good example recently, in the future will probably be Chain, right? Chain will come up with their own blockchain. And for that, they will need their own infrastructure, their own wallet addresses, and so on. All of that needs to be thought out and built up. So once a token warrant has been exercised, upon exercise date, the holder of the token warrant is not a bearer instrument. It's actually an instrument that is warranted to a legal entity. A legal entity actually owns this. And there's two ways of transferring this warrant. One is direct transfer, where the buyer owns the rights to the token warrant themselves, or they simply purchase economic rights of that token warrant, where, simply put, if you have, Greg, if you got a token warrant in your name, I'll give you, market price for it now. And whenever the tokens unlock in the future, you can just send the tokens over to me, or you can use my wallet address. And that's a P2P deal. However, this way, I'm taking on counterparty risk. If this counterparty, the seller, could just disappear overnight, I will have, not as much protection as I'd want to. And if it's a large enough transaction, institutional investors usually don't want to take that counterparty risk. And that's where we come in. We want to reduce counterparty risk for all of our users, both sellers and buyers. So buyers take on counterparty risk through ownership of the underlying asset. We want to make sure they actually own what they're paying for. And sellers, we want to make sure they're interacting with legitimate buyers who actually have the money to pay them. and they have the right terms, they're doing it at the right price. So we offer these protections throughout, more than just matchmaking between buyers and sellers. We help provide the back office for these trades.
But how do you help them protect that? That, I mean, like, what is the actual mechanism that you're doing that's doing that?
Yeah, actually, our key differentiating factor is the relationships we have with these companies, right? Now, let's say a seller comes to us, they've invested in the seed round very early, and they're sat on a pretty large markup, and they want to de-risk their position. It's quite normal to do that, and we help them do that, obviously. They come to us and say we've matched them with the buyer. Both parties have agreed on a price. And what's next is the answer. Well, this part actually is dependent completely on the asset being traded, right? Because this depends on what the initial investment structure was, what the buyer is actually purchasing. So what we usually, for 90+% of transactions, go away and do is we already have relationships with the companies that are issuing these assets. We go away to them and tell them, have you guys done secondaries in the past? If you guys haven't, this is a trade. Please give us a legal structure to get this through and transfer the position over from the seller to the buyer. Most of the cases, especially unicorns in crypto, they've already thought about this and they've already done these deals and they already have the legal structure in place. If they don't, we help them get that in place so that they're set up for secondaries in the future. Now, look, the company could always
does it ever happen? Does it ever happen where they block it or they don't want it to happen? I mean, what is the worst case scenarios here? Like, what is the worst case that you've seen?
Yes, there are scenarios in which companies have completely blocked off their secondary markets. For example, Consensus had a cap table freeze earlier this year because they were gearing up for a new investment round. There were other companies where either they had a price under which these trades could not actually go through, or they were blocking off all secondaries anyway, right? And they may have a few reasons to do so. One is, just give me one sec. One is actually alignment of incentives, right? It comes down to pure human psychology. The company could think, instead of the seller capturing that economic value of the upside, they could be issuing these assets directly to the buyer and getting that capital into their own balance sheet, right? So there's that conflict of interest. And traditionally, every company struggles with that. Historically, the Dutch East India Company struggled with that for a while, right? So it's been around for hundreds of years where this conflict of interest has existed and it will always exist. Now,
would you call it a conflict of interest in the true sense of like it's illegal or something like that? Or are you just saying that it's just like the owners or the CEO needs capital and he's frustrated that there's a capital flowing for his stock, but not to the company?
Exactly. It could be frustration, or it could just be, wanting to capture as much economic value as possible, right? Yeah. Especially now, another reason is price, right? Let's actually explore how we price these assets. A lot of the times, the assets we trade either haven't been traded before, or there's just no other liquidity avenue for them to trade. If they haven't been traded before, you need new structures to get these transactions through. If there's no other liquidity avenue, that just means that there's motivated buyers who want to purchase this asset, and there's motivated sellers who want to obviously let this asset go, right? And all we do is create a matchmaking mechanism between them. And the way we set prices especially for assets that have demand already, is by running auctions.
Right.
These auctions.
So you actually run an auction. You actually run an auction in Stix. Stix is running an auction. That's what you're doing then. You're basically getting price discovery through an auction.
Exactly. We get natural price discovery through an auction where buyers and sellers agree on prices and it's fully P2P. Pricing is very transparent. Bidders can see where the other bids are at, the number of bidders there are, and sellers can see all of the information coming through. The background of the
what do you mean by that? What is price? All the information?
All of the information. So the information we actually show to the bidder is number of bidders that exist, average bid level, and what the highest bid is, right? Yeah. For assets which have high demand, obviously the buyers need to be more competitive. They need to be able to be flexible on price. For assets that are low in demand and there's a lot of supply, sellers need to compete with each other. So it needs to be at the lowest possible prices for buyers to be interested in that asset. So we help facilitate this open market for these secondary market transactions, whilst also ensuring that conflicts are minimized with the companies in question, right?
Right.
In traditional, in the tech markets, SpaceX, for example, is notorious for secondary trades. They have had a cap table freeze for I don't know for how long. They've sent a lot of cease and desist orders to other secondary platforms that were actually trying to trade SpaceX, and this happens across the board. So our job is to ensure that buyers and sellers are meeting at the right price, and this ties back into the conflict, right? If, say, for example, we've seen a zero interest rate frenzy in crypto for the last 5 years, where excessive amounts of venture capital has flowed into the industry, and primary raises in 2020, 2021, early 2022 were very high. Valuation, the revenue multipliers were very high for equity sales. For protocol sales, they were at ridiculously high valuations. And for a lot of these companies, obviously valuations have gone down. And founders are now realizing they would want to fundraise again. And an open market with open price discovery could affect their future fundraise. And they need to be very, very careful of this. If there is an actual registered secondary trade, for example, Consensus was trading very actively on dozens of secondary platforms, over 75% discount from their previous raise. And now they're trying to raise at around the same level as where the previous raise was. It doesn't work because the new buyers are going to, the investors in this round are going to see that there was active.
I guess it's a bit of a perception issue in the market. I mean, we've and it's a good point with Tesla. If you look at I guess the way that I look at it is that there's an order book in the private markets as well, right? So, there's always a buyer at a very high price and there's a seller at a very low price in an order book, but it's not a clearing price, right? So
Exactly.
You may have like all these things trading out there, but you're not getting the best price possible. And I guess you guys are helping with that. But you also have, and I think, when a company does come around to do primary, the one thing they can benefit from is that a lot of these transactions are small, right? So their argument could be just to do the steelman argument on that, which is, the argument is like, well, there was a seller who was desperate and they sold like, $500,000 of shares. We're raising $40 million. We're never going to sell $1 million of shares at this low valuation. The company is definitely worth more. And for Tesla, I think it's very interesting because we were buyers of Tesla early on, and we continue to be interested in that, and we have them in some of our SPVs. There is not only blocks that come from them, from accepting people directly on the cap table, but there's hundreds and hundreds of SVP entities or funds that have Tesla in it, and they're selling their stakes. So you can come into that side, which is not a digital asset. I want to ask about the parallel here, but in a Tesla stock, you can buy Tesla, and you're sitting in a wrapped SPV inside of a wrapped SPV inside of a sold transaction. So you could have like 3 layers of fees, but still be getting a great price because the price has gone up so much. You're paying 3 entities on the way up, but you're not on the cap table itself. It's still that original one because there was a block on the transaction, and that's something people should understand for secondaries, which is a secondary doesn't always mean that you're on the cap table. It can, but it can also mean that you're grouping or clubbing together with other people so you can get a big enough stake or whatnot. Does that happen in the token side too? Because it seems very common in the venture and the LP direct that you might be sitting inside of a wrapper. Does that happen with the tokens as well?
Yeah, actually, I want to talk about 2 things: the type of buyers and then legal structures. Right? Let's actually see who buys this stuff. Right? Who the secondary investors even are. In traditional sense, it's huge. Institutional investors, sovereign wealth funds, you got pension funds, you got family offices, you got venture funds, growth funds, and so on, private equity, right? In crypto, who are the secondary buyers? Secondary buyers are family offices, whales, and growth stage funds, generally, who want exposure to a particular asset, and they know secondaries are the best way to get risk-return exposure to any industry, right? Their downside is pretty much capped. They can still get risk-adjusted upside, and in some cases, particularly in Celestia, we generated over $250 million in unrealized profits for our secondary buyers. So they've all done very well.
So
Now,
Celestia, even though they were not Celestia, even though it wasn't live yet, or if it was live, it was locked up. You were able to create
it was
liquidity
pre-launch.
for pre-launch. So you're actually creating hyped up, increased value liquidity for people that invested in these early stage tokens even before mainnet.
Exactly. So we started trading Celestia in Q1. Celestia was around $1 billion valuation then. We ran, I think, like 10 or 11 auctions for Celestia. And those auctions pushed up secondary price from a valuation of $1 billion to about $3 billion, right? So we pushed it to over a 200% premium to the previous primary price in a space of 7 to 8 months. And that actually, Celestia, if they actually studied the secondary market, they would see that there were long-term investors wanting to still buy out sizable positions. These were $5 to $10 million blocks, wanting to buy out sizable positions, even at a $3 billion mark. Celestia actually launched around that price, and these were liquid offers. Sure, Celestia's strategy was they made a lot of money for buyers on exchanges, right? By launching low, because they knew there was a lot of demand going up, and now it's at 15 billion, right? So that's a
15
very
billion.
good. Yeah, Celestia is one of the biggest winners this year. So that was a sort of a good example of how we actually do this natural price discovery. We knew where the bidders were, and we got this proprietary alpha, call it alpha, where Celestia Liquid trading at 2 to 2.2 billion was just massively overpriced, because we saw institutional buyers, all the large buyers you can think of in crypto, all the large family offices and whales, they still wanted exposure to Celestia. Of course, it's going to go up. There was a huge misprice between secondary and primary. So
what was that difference?
Coming back to the difference is obviously equity value of $13 billion, right? Because it went up from 2 billion to 15 in less than 7 weeks.
Wow.
Right? It was $10 billion of equity value flew into Celestia and the Celestia ecosystem. And they have done fantastically well, and I think they will continue to do so. Coming back to the types of buyers, right? First, which probably are 80 to 90% of buyers, which are in it for price, right? They want to make money.
Yep.
The second type of buyers, they're in it to make money as well, but they're also wanting direct partnership with the company, right? I'll give you a very good example of this, which was Animoca's recent secondary sale to Saudi Arabia, the Neom fund, right? Neom, I think, invested around $50 to $75 million into Animoca stock. Half of it primary, and half of it was a secondary sale. And they actually bought it at like quadruple the valuation we sold at Animoca in secondary just a few weeks earlier. Why did they do that? They wanted a direct relationship with the team. Obviously, the Neom fund is not really price sensitive. They're not in it to make a quick buck. They're here to establish these relationships. They want to create that branding and exposure to Animoca that they want, which is why they're also investing in Animoca, right? So that's the second type of primary buyer.
There's actually another reason. There's another reason, like we do, like when we do secondaries, there's another reason to do both primary and secondary at the same time, which is like due diligence. So if we're buying secondary, generally we're not getting any due diligence into a company or a token. If we mix it with primary, we might be able to get some due diligence in place, like either direct a data room or information from the CEO. But even better, that is if we partner with someone else that's doing secondary that's already done due diligence, that also can be super beneficial for our secondary pricing. Does that happen in the token side too?
Yeah,
where
of
people
course.
are
Especially
increasing
for
their stake.
Yeah, especially for larger purchases. I mean, we always get that where, for example, I already know what the two big winners of Q1 are going to be. It's going to be Eigenlayer and Monad. I think for the first half of
Mornad, say that again. Mornad.
MONAD. It's parallelized EVM chain. I mean, we see this, right? We see this demand. Sui was the biggest winner of Q1 this year. In terms of secondary demand, that was huge. I think we had like $200 million in registered bids, and it was all Asia, right? And now, if you look at Sui's liquid market, it's mostly Korea bidding Sui, and we already knew this, 12 months ago. And we can see that now with Eigenlayer and Monad. We can see huge amounts of interest flowing in, And Eigenlayer is something, we wish to transact large amounts of. And coming back to your due diligence issue, that exists. But at the same time, due diligence also exists on, crypto's open source, right?
Yep.
People want to due diligence tech. Eigenlayer is GitHub, open source. They can go on the GitHub, see what they're actually building. There's a lot of documentation publicly. So for token protocols, it's very easy. When it comes to companies like Consensus and Fireblocks, getting financial information, very difficult, right? For some companies, including Fireblocks, we did manage to source financials, and companies do that when either they have.
And you did transactions for them. You did secondaries for them, yeah?
Yes, we've done secondaries for both. And companies are actually okay sharing information to buyers they deem worthy, that buyers they think they can have a longer term relationship with, right? If for example, the Qatari investment fund comes in and says to, I don't know, just pick a random company, Fireblocks, okay, we want to do $250 million. We are exploring this $25 million Fireblocks block now. We're also going to be interested in 225 million more. And Fireblocks is going to think, okay, cool. These guys are coming in with 25. It's in my best interest to let the secondary trade go through. I'm going to help them on a form of relationship with these guys, because Fireblocks will need to do on a pre-IPO round. If it wants to IPO in 2025, they're going to need more funding. And so these are the relationships that they can build. So in some cases, they do open up their books. In most cases, they don't. There's also another thing I think we should explore, something called the ROFR, the right of first refusal. Right? ROFR structures exist in traditional equity transactions, and they exist at scale, private equity or venture capital transactions. And pretty much what ROFR, right of first refusal, is that whenever a primary investor or a team member or any shareholder wants to sell their position, the company reserves a right to refuse that trade. Right?
Well, isn't it that it's not that they have the right to refuse, it's the right that they have to match or buy it, right? Like
not really. No. ROFRs can be structured any way the company likes.
So there's actually two different types of ROFRs. There's one where they basically just have to approve everything. I think that's, and then there's the ROFR. Traditional ROFR is this the right of first refusal, meaning that you can go out and get a bid. Like, I'm going to sell your share for like $100. Then the ROFR owner can say, well, I can pay $100 for that price. And then they buy it. But like in the ROFR, because I think I'm in maybe like 55, 60 companies. All of our ROFRs in those companies are match trades. Like if someone else is able to sell the share for 500, we can basically say, no, we'll buy for 500. But as another investor, we can't block it. Some of those companies have like a cap table block, but that's less common than an actual ROFR because it's not as much beneficial for the shareholders. So can you explain the difference in ROFRs, whether you're matching and how often you see it as blocking?
It depends on the maturity of the company. I think most of the companies, that have match or buy, they have healthy balance sheets, right? These are late stage companies, the SpaceX's and Stripes and so on. So they're already very, very well capitalized. They have, usually hundreds of millions, if not billions on their balance sheet. And I don't think we have seen companies that well capitalized. I mean, there's only a handful, right? There's obviously the token companies, EOS, that did a $4 billion ICO in 2017. But in traditional, I think the only ones that are as well capitalized are probably going to be, Sorare, Fireblocks. Both of these raised over $1 billion, but it still is not enough to exercise that ROFR unless they come in and buy back cheap. If you actually look at buybacks, if you look at the Miston Labs, SUI, and FTX buyback. So FTX invested $100 million into Miston Labs on the Series B, and that was early 2022. And then this was obviously a large position on the FTX balance sheet. SUI realized that, and they had spare capital. They had just raised $300 million. SUI purchased the shares back at a 5% discount at a total price of $95 million. We were actually in discussions with PWP, Perella Weinberg Partners, which is the investment bank handling the FTX bankruptcy. We were in discussions with them because they came to us wanting to understand pricing and if they were getting a good price, right? We actually ran a mock auction for them that same weekend that Miston Labs made that bid. Miston basically gave them a 21-day deadline to accept or reject that bid. We went away and did that auction, realized it was actually underpriced. Miston would have traded for at least 50% higher. However, bankruptcies, they have a lot of due diligence processes, background checks. It takes a while. 21 days, you're never getting a transaction through. They're very slow.
Right.
However, Mr. Labs bought back that position. And they actually did a trade on it where they went away and did an OTC round at double the valuation. So they almost made their money back. They actually probably made a profit on that trade. And if you look at Aptos, FTX owned, I think, about $300-400 million in Aptos tokens, right? Okay. Aptos was not as well capitalized as Sui, or they just never thought of a buyback. And the FTX estate only last week released that they've already sold $250 million of Aptos on the open market, right? So if Aptos had bought that back, they would have controlled the amount of sell side in the market. So Aptos price would definitely have been higher because supply would have been limited in the market. There's lots of ways. And coming back into ROFR, like most companies don't actually match. There's no buybacks because companies are just not that mature in crypto yet, especially token protocols, because they have a very early path to liquidity. And we haven't seen buybacks. We've just seen blocks on the trades or companies that the trades through. So, yeah.
Yeah, actually, in the equity world, we also see the ROFRs are the other shareholders most of the time. So the ROFR is basically saying everyone that owns shares has a ROFR, a right of refusal, if someone's going to trade, so that we can keep the cap table close to vest, and it's an added value you have. So if there's 10 of us on the cap table, maybe the CEO owns 60%. So, in effect, it's the founders that have that big ROFR. But I guess you don't see anything like that in the token side, right? Because it's more of like a traded bearer asset. Or you do, maybe you do. I don't know.
We've seen that in Layer Zero. Layer Zero has ROFRs. They have a board of directors. They've been active in the secondary market. I think Layer Zero is a very successful company. It will be. So we've seen that in that asset, but most protocols don't have a board of directors. Right? Laser is obviously a very sophisticated company with a board of directors, and they also have these, selected investors who have ROFR. I think it's 4 or 5. It's the same with another company we saw, Figment. Figment had a pretty strict ROFR. We saw some stock options on the market. So again, the play with secondaries is that the reason why an order book can't exist, is because you would have to build an order book specific to the asset. Every asset has its own politics, its own deal dynamics, its own legal structures, its own back office, paperwork, its own type of buyers and sellers, its own jurisdiction as well. It's all over the place. Whereas tech generally is Delaware, right? Like most tech equities are like US companies. Delaware. There's law firms who specialize in this. There's buyers who already know what the legal structures are. In tokens, buyers don't know what they don't know what the agreements they're going to be signing is. So it takes them again another week or two to review these documents. There's lots of this sort of stuff we have to think about.
Is there such thing, in when you do an equity investment, there's a thing called like a preference right. So in equity, you'll have like the latest round of VCs have a liquidation preference so that they can get all their money back before the next investor that put in gets all their money back, and it goes down all the way until you have the founder common shares. And there's this waterfall of flows which make the older investors' shares worth less, and the commons, the founders' common shares worth very low compared to the time. So very often we find ourselves building these discount models. In digital assets, is there ever any sort of classes, or is there ever different types of tokens, or is this even, or maybe while it's still not mainnet, there's SAFs and stuff like that. Is there any sort of preference waterfall in the digital asset secondary?
I think that is such a good question. No, I don't. None that I know of, and I don't think there is any different classes of tokens. I think it would be a fantastic idea to have different classes of tokens, to be honest. Right? If tokens are going to become an asset class that, mixes commodities with equities, right? It's something in the middle. It needs to have characteristics of both. In equity, different share classes have been built for specific reasons. You could have a particular share class just for governance rights, right? You can issue a share class, and only holders of those shares have any governance rights in the companies. You've seen companies issue those where founders retain the governance rights, but actual value shares are sold, preference shares are sold, and the only thing that changes in preference shares is liquidation preferences. So if you can build that in the token model, where say let's take Celestia as an example. It's just a beautiful example. In my opinion, it was the best deal of 2023. Take Celestia as an example. The first round was done at a valuation of 10 million. The second round at a valuation of 75 million. Third round at a valuation of 1 billion. And now it's trading at 13, 14 billion FTV, right? Now, if you look at the first round investors, which were mainly validators and 2 venture funds and some angels, they're all sat on 1400x, and there's a very active secondary market of actually buyers wanting to buy things, right? And they hold a large percentage of token supply, so they have a lot of power and control. You could have something which is shareholder activism. You can have something like token holder activism, where these holders will still make up for something like 15%, 50 to 20% of the total token supply. They could band together and take over the governance of the protocol, right? Especially in the token ecosystem, governance is such an important thing. If you split token classes to investors have half the governance rights as founders have, or vice versa, whatever, that would actually fix the governance issue that most layer 1, layer 2 unicorns in the crypto ecosystem face. That's something I think Stix should probably explore, because we're in the right position to do so.
It's good that we're brainstorming for the company as well. But I think it is a challenge, though. It is a challenge for tokens, though, because you have in equities traditionally, and I've been dealing with venture and also as an investment banker when I was in Wall Street doing public equities. The preference concept is basically you can have a class of stock, and you have, as you said before, there's governance and there's economic rights, and then what they do is they're layering priorities of those up and down, like maybe less governance. Very often, like for Zuckerberg has 10-to-1 voting rights on his shares, or economic rights. A latest VC wants to make sure they get twice their money before anyone else does, because they're taking a bigger risk. So that's a liquidation preference, and they don't care so much about the voting. So that those things could be translated to tokens. But the strange thing I find in tokens is that there's not a direct, I'd say more often than not, if you think of all the shitcoins, for sure, more often than not, but let's say it's just more often than not, there's no economic connection with the operations of the company and the token itself. So the economic rights is nothing but a trade. And then if you're voting, it's like, are you voting for a DAO or whatever? I think that the voting could maybe be a place where you connect it. But in a preference share, it's technically talking about future cash flows. How often are these tokens, like you mentioned, IGAN, you mentioned SUI, you mentioned Celestia, how much of these tokens are getting actual operational cash flow or some sort of economic benefit connected to what they're doing, or their protocol, or are they just proxies?
I mean,
the brand, essentially.
The simplest answer to that, revenues are still almost non-existent in most protocols. Like the only protocols that make revenue now, Ethereum, Solana, DYDX, and you got some other handful of DeFi protocols, right? Revenue is still very tough, and you have to separate revenue between actual cash flow and sale of tokens. You are getting a lot of like protocols, especially between like 200 million FTV and a 2 billion FTV, doing a lot of OTC. So I mean, like there have been market makers.
Can you explain FTD?
FDV, just a fully diluted valuation.
Fully diluted valuation, just for the listeners to understand what you say when you say that.
The fully diluted valuation is just the overall equity value of the protocol, right? It's simply
not equity, but the price.
Exactly, price multiplied by total token supply. That's how it's charged. A lot of these protocols, the only way for them to have any cash flows is by issuing more. The equivalent in the traditional equity world is issuing more shares, right? By selling tokens on the ecosystem, raising more money, right? They either do it through market makers, or in the future they're going to do it through Stix. It's just what it is. They make money by selling more tokens. Now, however, our plan with Stix is to help companies do that whilst also ensuring longer term partnerships. So we're doing something called the Stix offering for quite a few unicorns starting Q1 onwards, where two things. Either companies can do on an ongoing basis OTC sales of their tokens, where the buyers are buying into a token that's already liquid on the market, but they're buying blocked positions. So they're vested over, for example, 12 months. At the end of every month, they get a 12th of their position back. And we can do this either on a monthly basis, so on a repetitive basis, or a one-off offering. One-off offering makes more sense for something like Eigenlayer or Monad, where they are pre-launch and there's still a lot of economic value to be captured. So operational cash flows, very tough. I mean, DYDX cash flows, there's still a governance issue there on how cash flows are distributed to token holders, and who decides what. There's still a lot of influence that founders have. It's all over the place. I'm not an expert in that, to be honest. I know Uniswap just implemented something to increase their cash flows, where if you're actually interacting on the Uniswap front end, there's an extra layer of fees that's added of 0.15%, if I remember correctly. So that's them trying to make more revenue. Where's that revenue going?
That's great.
Who knows?
Oh, okay. We don't even know that. Well, that's the thing. If there is revenues, then I guess that would become an evolution, the evolution of the tokens to try and, I guess they would naturally start to send cash flow to the tokens to make them more valuable.
That's
if the platform is creating. Yeah. Is it, does it change? I guess even the US stance in securities has made it so that they're less likely to push cash flows to their token. Is that what you found? It's basically
in an ideal world. I mean, if tokens were equivalent of shares, you just airdrop the US dollar value to each token holder. I mean, no one wants to go to jail for violating securities law, right? So it's all like the whole ecosystem we're still so early. Everyone says we're so early because we don't even know what asset class a token is. Somewhere in between security and commodity. It's not security, clearly. But, I mean, Bitcoin and ETH have been labeled a commodity, but,
Yeah, well, the U.S. government said that Bitcoin is a commodity, and various governments make different positions, and everyone's trying to regulate it. But that's really interesting. It sounds almost like the regulatory bodies have messed up the ability of tokens to generate or to lock in their value potential because they're specifically trying to avoid being a security. So it's very hard for them to, okay, we don't want to be a security, so we're not going to attach company cash flows to the token. Do you think that there's a built-in valuation to tokens that, I'm going to own, like let's say a Celestia, that I think maybe in 3 or 4 years the regulators will come around and the company will be able to attach cash flows to it? Or do you think it's just totally meme value?
Yeah, but I mean, first of all, understanding human psychology, founders don't want to go to prison. A lot of the times, founders are either US or UK.
I think it's not just founders. I think everybody doesn't want to go to prison.
Everyone, obviously, the investors. But like, I know so many large founders. They think about this a lot because most of them are US citizens. Now, second, I want to talk about the Middle East, right? Yeah. Like, I have spoken to some of the regulators here. I've spoken to companies building here. There's so much opportunity. Like, there's a big gap in the crypto market right now where there is not a single legitimate jurisdiction that has streamlined the entire process of how to judge whether or not a token is a security or not. Right? The EU currently, with their VASPs, has said as long as you're not a financial instrument and you agree to this definition of a digital asset, you may be a digital asset, but we don't know until we actually look into each individual trade. Right? The US obviously
there's no clear cut.
There's no clear cut. So what my belief is, the first jurisdiction to actually recognize that tokens have been historically used to raise, I think the number is probably like $50 to $100 billion in investment through private sales of these tokens, and recognizing that there's a clear demand for using this asset class to raise money, as well as giving investors early liquidity on their assets. And once that whole process, the investment process, is recognized by a regulator, like that jurisdiction will become the only jurisdiction that every founder in the world wants to go to. right? Say, for example, if the UAE recognizes this and they've developed a clear-cut process for raising through staffs, trading the secondary market. I actually think Andreessen's next office is going to be in Dubai, right? In Dubai or Abu Dhabi.
It should be. It probably should be. It should
every
be.
venture capitalist is going to come here. Every developer
Vara has made a lot of strides. I mean, you have Vara in Dubai is trying to do this, right? So I think the stablecoin regulations coming out, they're able to very swiftly legislate. I mean, the flip side to that is that they can legislate away from it very quickly as well, unlike other jurisdictions. So there's that kind of risk there.
Vara is an interesting one, right? We obviously, as a company, want to get regulated in the Middle East.
Mm-hmm.
Now, Vara is also a very young regulator. We've spoken to a lot of regulators here, and Vara is a very, very young regulator. It's also at odds. It's competing against federal regulators, right? And that's there's a little bit of friction between
federal Emirates regulators. So it's Vara is the Dubai regulator, and then there's the federal Emirates regulator, and they're competing with each other.
DFSA, the DFSA in Dubai, and there's an FSRA in Abu Dhabi. These are the securities regulators, and they have their own crypto regulation and segregation into for crypto companies. And Vara has emerged as its own regulator for free zones in Dubai, right? And look, most companies, I think. Okay, let me tell you how many companies actually have as of like a month and a half, 2 months ago. Only about 9 companies had a Vara MVP or operation. 2 had operational, 7 had MVP license. I think that number's probably
Can you expound upon those? So most people maybe don't understand what those are. So first of all, what's Vara? And then what are those licenses? Not that you're the regulator, but you know what they are. So if you can explain what those are.
Of course.
What's Vara, and then what are those licenses?
I think Vara is the Virtual Assets Regulatory Authority, which is a regulator set up in the Emirate of Dubai, only in Dubai, which regulates all virtual asset and digital asset activity in Dubai, carried out by Dubai companies and within Dubai. Now, Vara was set up about 2 years ago, and it's still a very young regulator, and it's got very clear-cut rules. It's got various levels of licensing. One is the advisory license. One is a broker-dealer license. I think there's a custody license, and there's another one. I can't, payments, I think. I'm not sure.
Right.
And also there's a proprietary trading license, which there's about 30, 40 of those. It's very easy. So if you're trading on your own capital, it's very easy to get a no objection certificate. So you're not regulated with Vara, and Vara does not cover proprietary trading at all. So it's a very clean jurisdiction. If you want to do proprietary trading through a legal entity, Dubai is actually a good jurisdiction. Now, Vara has, because it's a young regulator, they've been evolving for the last 2 years. They have different layers of, steps in the process where you go through application, you submit your application, and then once the application is received, they come back to you with a set of questions. Once, these questions could be on cash flows, actual business operations, the assets you're trading, jurisdictions of plans. And, it's about 500 questions, very, very in-depth. They understand the industry really well, right?
Yeah.
Once you do those questions, you get to the MVP stage, right? The stage 1. Now, stage 1 basically says, cool, we have basically told you that your business model fits our regulation. We think we want to do business with you, and we want your business to be set up in Dubai. You may now go away and start the procedure of setting up this business whilst we proceed with the application. That's what it means. Okay. So then you go on to stage 2, which is approval, pre-approval checks, and so on. And once you pass through the approval checks, you get something called an MVP license, right? The MVP license gives you the right to set up and start not operating, but start setting up the operations in Dubai. It could, for most companies, it could mean, you can start hiring people. You can start developing the tech platform. You can start, making payments inside of Dubai. And then the final stage is the fully operational license. And only 2 companies, I think, have been giving that. I haven't checked in the last few weeks. OKX, and I think Crypto.com. And I think Hex Trust was given an operational license as well. So these 3 companies. And that basically means you have your license, go and do the business, right? That's all that means. So Vara has emerged as one of the most clear-cut regulators for crypto assets in the world, and they're very, very clear in their messaging, their regulation, their motivation to work with the industry instead of against the industry.
Right. Yeah. They're very clear on that, and obviously I know about them. It's really good to get. I mean, you're local and you get to explain about it. And I guess Henson is the one running it. Really good guy. It's a great.
He's left, I think.
It's a great. Oh, he's left. Oh, okay, great. And then I think you have the city and basically Emirates in general has been very pro business and pro crypto, or let's say digital asset world as well. So that's quite a good boon. Let me just kind of shift gears a little bit to your actual like operational structure, because you have this company Stix, and you're offering a way for people to sell or buy secondary stakes in all sorts of digital asset digital asset digital asset tokens, even if it's locked up, even if it's in a SAFT, even if it's a forward contract. There's many different ways that you can buy what would be otherwise unavailable. So like you say, oh, I missed that. If I'm a family office or I'm an early stage VC, oh, I didn't get into that round with, Sequoia took over that round. I didn't get into it. I guess people are, with you, they can still buy some of those shares, because on the secondary market, it might be priced different. It might be up, it might be down. Now, and then the way that they can do that is either pure OTC, where you help them facilitate two people meeting. But a big offering of Stix, from what I understand, is that you actually can run an auction. So the seller is not only thinking like, oh, well, maybe I'm going to get 10% premium, but he can actually put it on your system and find out that he's getting a 50 or 100 or 1,000% premium when he didn't realize that. Now, how does that actually manifest into an actual transaction? Is that like, how much of this is like clicking buttons and just sending stuff between wallets and smart contracts? And how much of this is like phone calls, Telegram chats, and DocuSigns where you're facilitating? And what are the ranges of like, is this something where I can just go buy some secondaries this afternoon and I'll be done by evening? Or is this like, I'm going to buy a secondary in Celestia and it's going to take me like, I got to wait for the auction. And then once the auction's done, it's going to take me a month of transactions. So like, where's the spectrum in all these ways that you actually physically, how does Stix actually, and beyond Stix, how do people actually execute these?
Very, very good question. In terms of timeline, it takes anywhere from a few hours to up to 3 months, right? So I want to put that out there. Some transactions just take a while. We've been working on one transaction for the last 3.5 months, and it's still not gone through. We worked for another transaction for 5 months this year, right? It goes on in the back end. There's lots of stuff going on. So let me actually explain the entire flow of the seller and the buyer, right? The seller decides they want to sell something, right? They come to us, we onboard them onto the platform, and they submit a listing. And then we go away and do a bunch of due diligence. We all obviously have our own KYC, AML requirements. So every user on our platform is individually KYC. Every legal entity goes through very strict KYB checks. And once that is done, only then will they be able to upload a listing. So we already know the counterparty is real. Now it gets to a stage where we need to verify exactly what they own and if it's legitimate or not. So we try to do our due diligence upon the listing process to ensure that the seller is a valid counterparty. We need to be confident enough within the seller that they are who they say they are and they own what they say they own. And once we're confident of that, we list the asset on the platform. And bidders either they're already bidders on the asset itself and they get pinged that there's a new listing, or there's been no bids before and the listing gets uploaded to the platform. And then bids are either on a voting basis or we set timed and gated auctions for very high demand assets. And then now that's us from sourcing and a price discovery. That's sorted. Now the next step, when the buyer and seller have to agree on a price, right? There's a negotiation process built in completely into the platform. However, people may choose to do it off of the platform, through Telegram chats and so on. However, in the future, we're going to move the negotiation process almost entirely to the platform. We're also building a Telegram bot, which captures all of this. Once that's done, let's say the buyer and seller agree on a price and a size, $5 million at $1 billion valuation, whatever the deal may be. Once that's done, we enter the clearing and settlement stage. What does that mean? What is clearing of a transaction? Clearing simply means transferring the position and making sure the legal structure is all sorted. So it could be ROFRs, transfer documentation, sale and purchase agreements. Obviously, all of this is still legal work, and the legal industry is still very ancient. It's antiquity. It's lots of DocuSigns or even paper trails, right? So that's the most manual part. The clearing process is very manual. Lots of legal documentations to go through, to review, to execute. And then we come on to the execution part. Now, execution-wise, it's simple. Seller transfers the assets over to the buyer, and then buyer transfers the money, either fiat or stablecoin, over to the seller. And once each party has received what they want to receive, that transaction is labeled execution. We don't get paid until the transaction actually happens. We don't charge any retainers. There's no fees to onboard to the platform. We only get paid on a success basis. And
right.
That is the entire flow. Obviously, like crypto is very Telegram native. Once the buyer and seller have agreed on pricing, they usually talk to each other. As part of our roadmap to reduce counterparty risk, we actually introduce them to each other. So the seller knows who the buyer is, and the buyer knows who the seller is. And that's very important to understand.
Can it be anonymous? Is it possible? Can I go to Stix and say, I want to sell my shares or my tokens? I don't really want to be known. Like, is that possible?
It will be possible in some cases by the end of Q1 for us. We're actually doing something where we can be the counterparty if the seller wants to remain anonymous. And that will, in my opinion, make our process 50 times more efficient, right? And
I guess the ideal would be I want to be anonymous, but I also want to make sure the other side is AML and KYC authorized. So like I want to be anonymous, but I want to know that it's trusted by Stix and that Stix has some sort of like gold standard check. So it's not a terrorist or whatever.
We want to get
is that
there.
Kind of what you're going to, yeah.
We want to get to the point where that's trusted. Like if you're going and interacting with Goldman, right? And if you're buying something for Goldman, you already know they've done their checks. You already know it's Goldman stamp on it. It's gone through their compliance team. It's Goldman. It's a Goldman standard. It's in their name. It's gold, right? And we want to get to a point where we're certifying these assets. It's all about scale. If our regulatory roadmap, is over the next 6 to 9 months, and that's it. In 9 months, we will be fully regulated to be able to do all the things we want to do, set the gold standard in OTC trading, also be able to be the counterparty in these trades, where it could simply mean you sell to me, either I sell it on or I sell it first, get the money in, and I pay you then, right? And
that's how props do the OTC if they don't have a broker-dealer license.
Exactly, and that's like it's called I forgot the name, match principle, right? And match principle is not really brokerage. It's a type of activity where I sell it first, I get the money in, and then I use that to purchase the asset. Clearing for the buyer is delayed, but if we're a trusted counterparty, people will do that. Like we can do that now. We're not licensed to. We haven't done it in any trade so far, and in the near future, over the next two quarters at least, we have never custodied any transactions. We're never a direct intermediary or a direct counterparty to any trade. We never charge our buyers. We've only ever charged sellers, and we will continue to do that for most cases. So that's our roadmap. We want to make sure we're the gold standard for OTC trading. People trust us already. They trust us to have billions of dollars in actual value be registered on the platform as a company, to the point where we ran an auction for a very hyped up layer 2 protocol that's going to be launching soon. We ran an auction, and within 48 hours, we got $45 million in bids, and that was just from seven buyers. Implies an average, bid of $6.5 million per buyer. So we want to get. It's all a process. The company is less than 7 months old. We're doing the right thing. So our roadmap. Be able to trade securities ourselves, be able to escrow transactions ourselves, be able to be the match principal on the trade, the counterparty on the trade ourselves, and be a fully licensed digital asset intermediary. A broker dealer for digital assets is what we want to be. And how much of this is smart contracts? Almost nothing. It's all Web 2 per se. It's a fintech platform. However, we're building in Rails for token distributions. We're building in escrow, which is smart contract escrow, and stablecoin settlements. And this is literally all people need. We don't want to overcomplicate our process. Our process is very simple right now, and we want to keep it very simple and just add in tools which are very simple to use, but add value to the process. And our edge is always going to be the deepest liquidity in OTC book there is, and the most trusted OTC people to do it through. And that's our value add, and that's what we want to be.
So, I mean, that's a fantastic. I mean, that's a great like pitch for where Stix is going, and it's clear that there is there's a big spot for you guys in the space, and I think it's going to be very interesting to see you as the bull market returns and scales up. And then even more interesting when the bull market goes away, and we find ourselves. You know, I think we're in this world where there was just an enormous amount of influx of VC money the last 5 years, and it's not going to be as big in the next 5 years. So you're going to get liquidity disappearing. So you guys are going to be there. Can I stay a little bit on what we just talked about? I want to make it super clear for listeners.
Go for it.
When they're transferring an asset, like with you guys, so I'm transferring, I'm selling a million tokens of such and such, which are not liquid. They may just be document. It may be on a non-public. It might be on a mainnet, but locked up. How do I actually? How do I avoid getting scammed, or how do I avoid, or how does the transfer work? Because like, I need to do a bunch of documents. Are you guys checking the documents? Or are you just making sure both sides are there? Like, how do I get the green light that, okay, now transfer your token into this thing? And then I'm guessing 90% of the time there is no token transfer. It's just like a promise. And then an additional question on that is that promise sometimes like I'll actually have to come back and transfer the tokens I got in like 6 months? Like how often, how does that work? And how do you trust that?
Yeah, trust, again, you got right to the core of it. Trust is the core to the problem, right? Our job is to make sure we can do these trades at the right prices with the lowest level of counterparty risk possible, right? This is our third pillar. And obviously, fourth pillar is privacy and confidentiality. Do it in a private manner, right? Now let's explore counterparty risk. OTC is a very cutthroat business, right? I am in this business. We have done 0 trades, 0 deals so far with any other broker in the OTC industry. Mainly because, there are good players. I'm not saying, my competitors, I will never shit on my competition. They're helping me grow my business because they're doing my marketing for me, right?
Yes.
So some of my competitors are decent. However, they're not. There are other players who are not. There are players who scam people. I myself have been scammed. It's one of the inspirations why I started the company, and lots of my friends have been scammed. Right? I have, we get reached out to verify our trades, verify third-party trades, just as a third party to those trades, and we don't get paid, and we still help them anyway. We give them our back office, we give them our operations for them to use, and our insights and our expertise. And see, these are friends who have traded with us in the past. And if they got a third party, if they're a buyer and they've already sourced us, fine, cool, we'll help you do that trade anyway, right? Now,
but you said it's cutthroat. What do you mean by cutthroat? Does that mean that the people are shady, or they're just very, very shrewd? They don't want to share the fees. So what does it mean when you say cutthroat?
Yeah, like traditional OTC, as in like Bitcoin OTC, Ethereum OTC, I get reached out to by at least, on a mild week, 25 different scammers a week, right? 25 at the minimum, right? And these are people, either it could be something like, I've got an investment in, I don't know, just take a random company, Celestia and the Cedar. Most of these people are lying, right? It's not most, but we verify the counterparty. That's why verifying that the seller is legitimate is so important. We want to make sure that anyone who interacts with us gets what they want, right? Every single Celestia trade, for example, right? It was done through regulated entities in the EU, and it has so far generated 250 million plus in unrealized profits for all the buyers. And they're getting realized because all of these buyers are earning, 18% staking rewards. So they're getting like a third of their principal back every single month. So they've done really well. And we did these trades to minimize counterparty risk. What does this actually mean? Let's dive into that. For the seller, what does minimize counterparty risk mean? First, identity leak. We want to make sure that the sellers that want to, they don't want the market to know they're selling, especially if it's team members or some high signal investors, right? They don't want the market to know they're selling because they have, marketing and so on that they do. And it's quite anti that. So we ensure that does not happen. Second, that they are dealing with trusted counterparties. That basically means the buyer who's bidding on the asset is an actual buyer and he's the end user. They're not representing anyone else. They are buying for themselves or companies they represent, right? If you're the buyer in a particular trade and I'm introducing a seller to you, I already know you represent multiple funds as well as Humla Ventures and yourself. That I know you have been involved in hundreds of millions of dollars in transactions, especially in the crypto industry, and I know you're a trusted counterparty, right? We do those checks manually as well as automated checks. Now, for the buyer, what does reduction of counterparty risk mean? As long as buyers can ensure they have full ownership of the asset at the price they want to buy it at, they're fine. They're happy. And the seller obviously is not involved in money laundering. Is in some cases you can't. Yeah. Go on.
Well, how do they do that? Like, do you have like a DocuSign that you send them? They sign the agreement, and then now you're able.
We work with SumSub.
Okay.
We work with Sum and Substance, the largest KYC AML provider, especially for crypto companies. The same, I think Bybit uses them. I think Binance uses them. We have thorough AML checks. Sum and Substance. It's called SumSub. The company's called SumSub. Okay. They're a KYC provider that we've integrated. So actually, if you go and sign up on our platform, every listener, you will actually be needed. You're going to have to KYC personally. That KYC check also includes an AML check, right? High-level AML check, running it through AML registers, and if it flags up negative, you're not going to be able to use our platform. First of all, we already created that barrier. And each transaction also goes through AML checks wherever it needs to. Now, that's one of the concerns that buyers have. Sellers not laundering money, the sellers legitimate, making sure they have their, we've already KYC checked them. That means we have their passport and so on at hand. We don't share it without the seller's consent, obviously. All of these checks. And the final question, which you asked, was how does the paperwork work? What do the buyers sign? Who provides that documentation? Who writes those documents? Who reviews these documents, right? Most of the time, these documents are issued directly by the companies, right? We are not a law firm. We never portray ourselves as a law firm. We're simply, in its simplest words, Stix is a matchmaking service for these transactions. That's it.
Right.
But we provide expertise whenever needed. We rely on the company whose asset is being traded to provide the documentation to trade this asset. If I go away and currently, do a secondary for Eigenlayer, right? We're actually in touch with them. We're going to actually text them and say, look, we're going to email them, be in touch with them and tell them, look, this is the secondary trade. Buyer and seller have agreed to the price. We would like this position transferred. What are the next steps? In cases where it's been traded before already, they already have the documents ready. And they're going to send it over to us, and both buyer and seller review the documents. In cases where it's not been traded and the company is okay for them to be traded, they will issue new documents anyway. It's their responsibility. Now, the company could just go away and say no, exercise their right of first refusal, or they could just say no to any secondary trades. Then either depending on the documentation, the seller could decide not to do it, or the seller could decide, okay, legally I'm still allowed to sell, but I'm going to sell it through other legal structures. In most cases, these documents called forward contracts. SpaceX stock is currently traded either through SPVs or forward contracts. That's it. And forward contracts, simply put, is a contract where the sale happens now, but delivery of the assets happens at a deferred date, some point in the future. Let me give you an example. I am buying something from you. I'm buying Eigenlayer tokens from you now, These tokens have a 3-year long vest. Tokens have not been issued yet. You have a token warrant to purchase Eigenlayer tokens. I want to purchase your token warrant. You invested 100 grand. I'm going to give you 500 grand. You're making a 5x multiplier, right? Now I'm going to pay you. We're going to sign this forward contract. The conditions are: I pay you now. Either when you get tokens in the future, you forward them onto me. So you transfer it onto me. We can do that through smart contracts. Or in the future, before token launch or post token launch, if you have the ability to directly transfer this position, you will do so. That's it. It's just deferred transfer of the position. And these contracts,
do people ever give collateral? Like say like, hey, I'm going to do this transaction. I don't really trust you. I mean, I KYC'd everything, but like you're kind of like, I heard a bad thing about you or someone, whatever. Like I need you to put up Bitcoin. We need to have like a joint Bitcoin wallet or something. And until you transfer me this asset, and we've done this transaction, we're going to have like maybe we're going to use an escrow account at Copper, or maybe Stix has an escrow account. Is there something where there's an extra layer of insurance money, or even insurance? Maybe there's an insurance policy. Like what is the way that I can increase my trust?
Very good, a very good question. We don't have escrow. We will have escrow in the next sometime in the next 6 months. We do have escrow providers. Yeah. You could use escrow. Mm-hmm. Now the escrow doesn't actually need any collateral. The money could just be held in escrow until delivery of the assets, right? If the seller's okay with it, cool. But we need to make sure. We need to make sure that the seller's okay with it. And it's almost like a negotiation between the two parties. They have to talk to each other to see what works, what doesn't work, or pick from a list of different structures that they can use. Collateral, yeah, that does happen, man. Like the That's stories rare, I've heard, I have not been in crypto too long. I've only been here since 2019, right? OTC trades have been happening at size for the last 14 years. Ever since crypto has been out, OTC business has been out.
Wow, right? OTCs have been in every asset class.
Every asset in crypto has happened ever since crypto's been around, right? People trade between, if you've got something, I want to buy it. Yeah. If you've got trading cards, or if you've got paintings, it's all OTC. Now, people have traded tens of millions of dollars per investment on forward contracts, right? And people have gotten burned. In 2017, there were a lot of scams for Polkadot, as well as I think like ICP when Internet Computer ICO was. There was lots of scams. I actually know people who lost millions of dollars through these scam forward contracts with the counterparty. Either they never verified them, or didn't KYC them, or was just a fake KYC. The counterparty was lying about their identity. They went away with tens of millions of dollars. It has happened. People get seriously burned in the OTC industry. Now, we want to just provide
rails. You have immutable transactions. It's much more risky in our space.
Exactly. You sent the USDT, that's it. You have nothing. If you've done a bank transfer, at least the bank account owner has KYC to get that bank account set up. If it's Bank of America and you're sending money to Bank of America, you know that like they've KYC'd for that Bank of America account.
And they also, then the one positive thing, well, I guess in these kind of transactions, the one positive thing about a bank is that you actually don't have real clearing, right? So if the guy is a scammy, you can actually reverse that transaction 30, 60 days often.
30, 60 days, exactly.
Now we don't like that because it's like third party. There's, you have to trust the bank. It could get lost in the system. Governments can lock it up. There can be nefarious actors in there. But now you're interested, in your space, someone like you is going to be super necessary because there is no reversing anything. You got to trust it. The deal's done. What about market? What has been the market for secondaries over the last 12 months? And we're about to enter, 2024. Everyone's anticipating ETFs coming out for Bitcoin. Everyone knows the Bitcoin halving's coming, and that's like alt season's going to come. What is the market for secondaries look like last 12 months? And what's it going to look like when things are just running?
Yeah, so let's go with the last 12 months. In November, FTX collapsed. Now, that left behind a very clear-cut opportunity for secondary markets, which is when I actually started doing my trades, right? I was very active in FTX claims, and then I also became active in secondaries, which is what, took me off. I was actually the first person to trade these assets at scale starting post FTX. And it left behind a very large opportunity for distressed sellers to sell, and there was a lot of distressed selling and buying going on. But some buyers got into some assets at ridiculously good prices. Obviously, like I know these people who purchase and they're very wealthy already, right? Bitcoin's in recent weeks gone up. In 2023, risk capital in the first 2 quarters was very low, right? Early stage funding rounds weren't being announced. Growth stage funding rounds were taking 6 to 12 months plus. There was no capital entering the markets. Now, Q3, Q4, liquidity did start to pick up. Bitcoin obviously rallied, Solana rallied. There was a lot of wealth created in the Solana ecosystem. And if you study previous starts of previous market cycles, private risk capital actually takes 2 to 3 months from an initial Bitcoin value of 30 to 40%. And we are seeing that now. From the rallies that have happened in October, we're seeing lots of private interest now. I would expect in January and February, it continues to do so. Obviously, I have no insight into what happens to Bitcoin price. There's lots of trading firms who put up amazing research reports of what could happen. However, it's the first time since 3AC and Luna collapsed, early 2022, when I'm actually seeing private capital come back in. Lots of good funds are starting to fundraise again, which is, quite odd. Interest rates are, they've halted the raise of the interest rates. If they fall, some allocators will still want to allocate into these venture funds, although not at the pace as they did in 2020 and 2021. GPs who have especially used us, we've got 100% success rate for GPs who've sold through us and have gone away and closed their funding rounds for their new funds. We are the best use case for GPs who want to get DPI for their LPs. DPI is distributed capital back to the LPs. And LPs, the only metric they have right now to go off of is how much money have I gotten back from my initial investment. So I think what we're going to see is we're going to see a lot of tier 1 funds starting to do their fundraisers again. We're also going to see some emerging fund managers starting to do their fundraising again. I think some of them are going to be successful. There's going to be risk capital coming in, and hopefully it's good for the business. And if things become the same as the 2021 bull market, I don't see a reason why we wouldn't be able to do 25 to 50 million plus every single month, even more, which is what the key private players then were doing. Launch pads like Coinlist and DAOmaker.
Do you think the market for secondaries will change when there's a bull market, though? Because right now the secondaries market is about getting unrealized returns for things that are hypey, but also doing down transactions off market, right? Or getting a little bit more value for your massively underwater position. Actually, it's a good question. Why don't you? How much of the transactions in the last 6 months with Stix have been massively underwater transactions that are getting a little bit premium because of your auction, versus hypey stuff that's getting getting price discovered because there's so much demand? And how is that going to change in the next 12 months?
The secondary industry is a very good victim of the Pareto principle. So the Pareto principle basically says 20% of transactions create 80% of the value or the volume, right? We're a victim of that, where we have 10 to 20% of the overall market of assets that create 80 to 90% of volume, because all buyers want to buy those assets. Eigenlayer, that's why I think Eigenlayer is going to absolutely rip in the coming few months, because everyone wants exposure to this one asset, and everyone wants exposure to 20%, or I think it's low. It's about 10% of the assets in the market. Everyone wants that exposure. So what does this mean for pricing? Especially if you run an auction when there's limited supply, like there is for ZK Sync, like there is for Eigenlayer, like there is for Starkware. It actually happens at premiums to the only existing data point that exists, which is either previous secondary valuations or previous primary valuations, right? So last 6 months, almost all the transactions have been, I would say 80% of the transactions have been premiums for the last round. And then obviously equity transactions are usually down, watered down. 5-blocks consensus, they're still trading massively down. 5-blocks, I think there was a trade between 25 and 80% off recently that I'm aware of. So there's a big split between the asset classes. That there's shares in crypto companies and crypto unicorns. Ripple, Consensus, there's Chainalysis, there's Fireblocks, all these high quality companies that people still want exposure to, and then there's tokens. Tokens have that liquidity premium. People are going to get liquid within 2 years. Shares, longer holding period. You want to wait for an IPO or you want to sell in secondary again. Who the secondary buyers are going to be? Analysis of the next strategy. I think the buyers for shares are a lot more sophisticated, right? Generally, institutional investors want to buy shares. Obviously, you guys hold a lot of equity positions, most of them token. And then token investors, they're the degenerates, they're the whales, and they want to get early liquidity. So they're less price sensitive because they know their downside is pretty much protected. Buying Eigenlayer at $4 billion, you're not going to lose money, right? Like, it's going to be a $20 billion protocol. It just is. And the early investors, they're still getting 100x on their initial investment. They're only selling their position partially, like 5 to 10% of their position gets exited. They make a 10x realized. Distribute that money back to their LPs. So, yeah, most things are still trading at premiums, especially in the token space. How does it change in a? Oh, let's see.
Sorry.
How does that? Sorry. How does that change in a bull market? It's quite straightforward. I think there'll be more people wanting exposure to a growing, a shrinking list of assets, right? Creating more and more demand for these assets pre-launch. We will also see uptick in demand for OTC deals for listed tokens. So tokens that are available on Binance, SushiSwap, or BitMEX or whatever. Tokens that are available, but people want to get in cheaper to the current price, and they want to lock themselves off for 6 months. So we're going to see an uptick in that. We're also going to see an uptick in protocols doing treasury sales. Peak of the bull market, NEAR raised $1 billion. Luna raised $1.5 billion. Polygon did like a $500 million round. There was all of these rounds that protocols.
Those are primary rounds. Do you think that you'll do? Those are primary rounds. Will you do primary as well? Maybe later.
So we actually want to help protocols do OTC, right? We want to do that as quickly as Q1, right? We want to do that in Q1, which we're going to call it a Stix offering. Now, why would a secondary trading platform want to do that? Because end of the day, it's still on protocols selling their treasuries. They already issued tokens that are held liquid in the protocol wallets. Now, protocols will be selling this in the secondary market because they will be selling, them to locked investors. Investors are going to be locked up for 12, 24 months or whatever vesting schedule they are. I recently personally purchased another, token project recently on Cosmos. I was locked up for 6 months. And these deals are going to happen a lot more often. What we're going to facilitate is a simple dashboard like Carta or AngelList do for companies, for them to be able to manage who their buyers are, see KYC information of each of these buyers, manage their wallet addresses, and use external token distribution tools white labeled on our platform, and just have a simple, easy to use liquidity avenue that has all of these tools built in. We can push it out very quickly, and we're already working on it, and we want to help be the trusted OTC partner for a lot of these large layer 1, layer 2 large protocols that are unicorns in crypto.
I suppose you could actually have an API to make it accessible from like for Medium or Apex or one of these the fund administrators.
Fund management, really exactly. Yeah.
Wow, it's fantastic.
Co-investment opportunities. We can actually spin up SPVs, offshore SPVs, really quickly. If you were to go away and set up an SPV that has USDC subscription or USDT subscription, you can't use any external service providers right now, right? Like, it's so hard to set up an SPV and fund it with with stablecoins and have the right documentation for stablecoins. Like, we can do that instantly, right? Like, obviously that's not our core business. Again, we're just a trading avenue. We want to offer these services just to help investors have it in place so that our deals are quicker. That's it. End of the day, we want to make sure deals are done as quickly as possible.
So for the LPs listening or the investors listening, why are secondary tokens a good investment for like a portfolio? Like, why is someone going to do these? And like, if they've never done a secondaries before, like the word might be scary to them. I don't know if it's scary, but like unfamiliar to them. how does it, why is this good for an investor to know about and to explore with you? And is it easy just to get up and start doing it?
Yeah, it's very easy to get up, start doing it. As long as you know the assets you want to purchase really well. If you've researched something and you want exposure to the asset, most of the time, the only way to get exposure is in the secondary market, right? If you wanted to go out and buy Eigenlayer right now, you have to buy someone else. The company's not raising any money currently. If you wanted to buy Eigenlayer, you have to buy in the secondary market. That's one, they're forced to. Second, secondaries have always had the best risk return profile. Why? Because if you're doing early stage investments, you have almost nothing to go off of. There's no actual company track record. There's no like 5 years of financials, or there's no publicly available technical documentation or operational documentation that you can review. You're just going off of the deck and you're trusting the founders and company roadmap. Whereas if you're buying secondaries, you're investing in a growth stage company that has most of the time has already proven a product, proven they have traction, proven their go-to-market strategy, is well capitalized. Is really important. This point is very important, that you're buying into a well capitalized protocol with trusted founders, and you're also carrying on the piggybacks of other investors who have trusted that protocol enough or that company enough to give them money in a primary round, right? So, for example, if I know Humla invested in a company, you guys have already done your diligence. I know you guys. I trust you guys. If, for example, another tier one VC, whoever, Sequoia, goes away and does an investment, or Andreessen does an investment, you've already got that tick. That, there's a good brand attached to this. Well, you're buying into a well-capitalized company.
That's like, for us, it's even a thing. Like that's why we've spun up our secondaries business, and it's so important. It's because as a leading VC in our space, but we're still not, we're not Sequoia, which is this massive, established brand. So very often you'll have these big deals will get crowded out by a big player. They'll say, we're taking the whole round. So small VCs, small angels, small LPs don't get exposure. And in secondary world, you get this magical moment where there's so little competitive tension and there's no one else there. And the big VCs don't care about this, like $1 million stake. All of a sudden we can get access for our LPs. You can get access for your platform LPs. Basically secondaries are like this magical part of the market where the J curve is compressed, liquidity is closer. I like it. I like your take on it.
Circle as well. It's a very tight circle because most of the time you know who the other buyers are. You talk to them. You got a community you're investing alongside, or there's a lot of things that make secondaries really attractive. And look, on our team, we also have Jeff. Jeff was our CPP Investments. He built out CPP's secondary trading business, which are 40 billion AUM now. He's sold a private equity firm in the past to a very large bank. He understands secondaries really well. His firm that he was an executive at actually was one of the founders of GP-led secondaries, right? They invented GP Stix. And this new idea of actually investing in, it was called Dial Capital Partners. And one thing that he's told me, I mean, he's got a lot more experience than I do, and he's told me that most of the innovation in the last 2 decades has happened in the secondaries world, right? All of these innovative financial structures for investments, all of these legal structures and legal pathways that have been created to make sure an investment can go through, right? It's all happened in the secondaries world, and it's still like a very early space. If you wanted to go and buy SpaceX stock, it's not that simple, right? If my mom wanted to go and buy exposure in Stripe, where's she gonna it's still very fragmented. There's fragmented pockets of liquidity. Brokers don't work with each other. You don't know if the broker you're interacting with has other broker on the buy side. It's just all over the place. As Stix, we just want to be clean. We have no intermediaries we're working with. We're always to the end user at all times. We're always direct to the seller, always direct to the buyer, always direct to the company. We have these relationships, right? Especially, with a company recently, the seller invested 2 years ago. They weren't in touch with the company. The buyer was in touch with the company. We texted the company, we emailed the company, and they responded to us immediately, and we got the trade through in like 3 days. And that's a relationship we build up. That's a reputation we build up. We're going to continue. We're very young. We're a team of 8 people. We're very, very young. We have a long way to go.
That's fantastic. Well, I think, I mean, this has been a fantastic conversation. Is there any question that I should have asked you that I didn't, or something that you'd like to say about your future background or about the market?
I mean, one thing, I think we've spoken enough about secondaries, market, VC. We've spoken enough about that. I think one thing I do want to, I've got this platform now. I don't think enough students take risk. I studied in the UK. I grew up in the UK. The UK is a very anti-risk place. Venture capital still doesn't exist. You got like tier one newspapers advertising like £500,000 rounds, right? Like Andreessen recently opened their office there. But I personally, I'm a student founder. I studied at physics at Cambridge. I'm also a recent graduate, and I think lots of our friends, are risk takers because we're in the crypto community. But even outside of crypto, those students need to be taking on more risk, because if you're not going to take risk in your early 20s, what are you going to do? You're going to take risk when you're 50 with 5 kids and a mortgage to pay. It's not going to happen. You have to take risk in your 20s. Most students don't do that. They're still going after the investment banking internships. They're still going after things that tens of thousands of other students are piling into, and these are outdated industries, no innovation going on. They hate the industries that they work in. So yeah, man, that's one thing I wanted to say. I think most students.
So your advice is that young people should play in this space to take risk because of the innovation and the opportunity. I would say the most important thing in your 20s is also to build some skills or knowledge. And obviously, this is a unique space where there's not as much knowledge already. So there's a place to make your mark. I definitely think things are changing. Important. Yeah. Relationships and market important. Changed. I mean, that's the theme of our whole. That's the theme of Transform, which is that everything is fundamentally transforming right now, and so you want to be on that wave. I like that advice from you, like to get on that wave of transformation and to be taking some risks, to putting yourself out there, putting yourself in learning situations. Like, it is true. It's another point, which is you can actually have a great success, but you can also have a great blow up in your 20s, and it is not going to affect your life on the long term. Like you can lose everything at 23, and then 25 you have everything back. You'll have more education from a massissive loss at 23 than you will, just keeping the status quo working.
When I was 19, I lost everything I had. I made that money in crypto in the first place. Lost everything I had. Sure, I learned more from it. I was more mature after that, to the point where I'm a recent graduate and people trusted me with millions of dollars to raise a seed round, right? That sort of thing is very, very valuable. It puts a lot of responsibility on your shoulders at a very, learning age. That's something I think lots of students are doing, and I think only students in the top universities are doing. I think everyone should be doing it because crypto is a level playing field, and I've been very grateful to be in this industry.
Well, the thing that crypto brings to the world, especially to Americans, is Americans also don't have access to any risk taking unless you already have $1 million because of the securities laws. So if you're not a accredited investor, you can't even participate in a lot of these early stage investments. Yeah. Whereas in the digital asset and crypto space, there's so much gray area, and I don't advise this. I'm not making a recommendation, and for sure, no one should ever put more than they're willing to lose 100% on. But you can do that, so you can kind of learn about something, put it in an interesting project or whatever. But our investors are very conservative. Our main goal is to basically, to protect our LP money and make sure they're getting multiples alpha on top of this emerging fintech markets technology stuff. Whereas the average everyday person can do this kind of fun learning process as well. I like that. That's good advice.
It's a low barrier to entry for people to be involved with in this industry.
Great. So this has been fantastic. Hopefully we can do this again sometime in the future. I'm really grateful to have you on the podcast. And it's been great. I invested in you, and I'm very happy about that. I think it's going to be, I have a lot of confidence in what you're doing. And since I'm also in the secondary space, it's very strategic. We have a great, I'm happy to have you as a friend and a colleague and as an investor. So grateful you show up, and looking forward to seeing you again.
It'll be my pleasure to come back. Thanks for hosting me, Greg. Thanks for being a great investor.
Thanks so much.
Thanks, everyone.
So thanks, everyone. This has been Transform with Greg Carson about financial markets transformation and everything else. Our fantastic guest has shared a lot of his insight, Taran Sabharval. We'll see you guys all next time.
Thank you.